Something strange is happening in the economy right now. The stock market is hitting record highs. Corporate profits are booming. Headlines keep telling us the economy is stronger than ever. But for millions of people, life feels harder than it did just a decade ago. Rent keeps rising. Groceries cost more. Buying a home feels impossible. And somehow, even people with good jobs feel like they're falling behind. So how can both of these things be true at the same time? How can the economy look incredible on paper, while so many people feel completely broke? In this video, we're going to break down what's really happening behind the numbers, how the modern economy actually works, and why younger generations are experiencing a completely different financial reality than the ones before them. Because once you see how the system really works, the economy starts to look very different. Please like, subscribe, turn on notifications, and comment the next video topic in the comments. Something about the modern economy feels deeply confusing. Everywhere you look, the numbers seem to say everything is going well. The stock market has been climbing for years. Major corporations report record profits. Headlines celebrate strong economic growth and technological innovation. Politicians talk about the strength of the financial system and the resilience of the American economy. On paper, it sounds like the country is experiencing one of the most prosperous periods in modern history. But when you talk to many people in their 20s and 30s, the story sounds very different. They say rent keeps rising. Groceries cost more than they did just a few years ago. Saving money feels nearly impossible. Buying a home feels like a distant dream. Even people with stable jobs and college degrees often say they feel financially fragile. They are working hard, yet many feel like they are falling further behind. And something else has been happening at the same time. Rates of anxiety, depression, loneliness, and financial stress have been rising among younger generations at levels that researchers have never recorded before. This creates a strange contradiction. The official economy looks strong, but emotionally and financially, millions of people feel weaker. So the first question we have to ask is simple. How can both of these things be true at the same time? How can the economy appear successful while so many people feel like it is not working for them? To answer that question, we need to look closely at what the economy actually measures, because many of the numbers that dominate financial news do not measure everyday life. They measure something else entirely. When economists talk about economic strength, they usually point to a few major indicators: gross domestic product, corporate earnings, unemployment rates, stock market performance. These numbers tell us important things about business activity and investment, but they do not tell us how easy or difficult life feels for the average person. The stock market is one of the clearest examples of this disconnect. When the market rises, investors celebrate. Headlines describe record highs and booming sectors. But the stock market does not measure the financial health of the average household. It measures the value of companies and the expectations investors have about their future profits. And the people who benefit most from rising markets are the people who already own the largest share of those assets. Ownership of stocks in the United States is heavily concentrated. A relatively small portion of households owns the majority of the market. Many Americans have little or no direct exposure to it. This means that when the stock market surges, the gains flow primarily to people who already hold significant investments. For everyone else, the effect is indirect at best. Someone might hear about record market highs on the news while still struggling to pay rent. This gap between financial headlines and daily life is the first layer of the economic paradox. But it is only the beginning, because the deeper story involves something even more important: assets. In the modern economy, wealth is increasingly tied to ownership of assets rather than income from work. Assets include things like stocks, real estate, business ownership, and investment funds. When the value of these assets rises, the people who own them become wealthier. But if someone does not own many assets, rising asset prices do not make their life easier. In fact, rising asset prices can sometimes make life harder. Consider housing. For homeowners who purchased property years ago, rising housing prices create wealth. Their home becomes more valuable over time. But for someone trying to buy their first home, rising housing prices create a barrier. The same trend that builds wealth for one group can create obstacles for another. This dynamic has become one of the defining features of the modern economic system. Older generations who entered the housing market decades ago often benefited from lower prices and steady appreciation. Younger generations entering adulthood today face housing markets that are dramatically more expensive relative to their incomes. This difference alone can shape financial trajectories for decades. But housing is not the only example. Education costs have also increased dramatically over time. For many people who attended college in earlier decades, tuition costs were far lower relative to wages. Students today often rely on loans to finance their education. Those loans follow them into adulthood. By the time many graduates begin their careers, they are already carrying significant debt. This creates a financial starting line that looks very different from the one previous generations experienced. And then there is healthcare. Medical costs in the United States have risen steadily for decades. Insurance premiums, prescription costs, and medical bills consume a larger share of income than they once did. For younger workers trying to build financial stability, these costs add another layer of pressure. When you combine housing costs, education debt, healthcare expenses, and everyday living costs, the financial landscape begins to look very different from the one many older Americans experienced in their early adulthood. This does not mean previous generations did not face challenges. They certainly did. But the structure of the economy has changed in ways that shift where the pressure falls. Today, the burden of rising costs often lands on people who are just beginning their financial lives. At the same time, the rewards of rising asset prices flow toward people who already hold significant wealth. This is why the economy can feel strong and weak at the same time. Strong for investors, strained for many workers. But this system did not appear overnight. The forces that created it developed slowly over decades. Some of them are tied to technological change. Others are tied to globalization. But one of the most important turning points came during a crisis that shook the entire financial world. The global financial crisis of 2008. During that moment, governments and central banks made a series of decisions designed to prevent economic collapse. Those decisions succeeded in stabilizing financial markets. But they also reshaped the economy in ways that few people fully understood at the time. Policies that were meant to be temporary became long-lasting. Interest rates stayed low for years. New financial tools were introduced. Massive amounts of money flowed into markets. The goal was to stimulate growth and rebuild confidence. And in many ways it worked. Markets recovered. Companies expanded. Investors saw enormous gains. But the benefits of that recovery were not distributed evenly. In fact, the recovery created a system that amplified the importance of asset ownership even more than before. Those who owned stocks, real estate, and financial portfolios often saw their wealth grow rapidly. Those who relied primarily on wages saw a much slower improvement in their financial situation. Over time, this gap widened. And as it widened, something else began to change. The emotional experience of the economy. Younger generations began to feel something that economists rarely measure. A sense that the system was becoming harder to navigate, harder to enter, harder to climb. They watched housing prices rise faster than their savings. They watched education costs grow while wages struggled to keep up. They saw headlines celebrating economic success while their own budgets felt increasingly tight. And this experience created a powerful question that millions of people began asking. If the economy is doing so well, why does it feel so difficult just to get ahead? That question sits at the center of the modern economic debate. But to understand the answer, we need to go deeper into the story of what happened after the financial crisis. Because the policies that followed that crisis reshaped the flow of money through the entire financial system. They created an environment of extremely cheap borrowing. They encouraged massive investment in financial markets. And they set the stage for one of the longest bull markets in history. What happened next changed the relationship between wealth, work, and opportunity in ways that still define the economy today. And to understand that transformation, we have to return to the moment when the financial system nearly collapsed and explore how the recovery strategy created the world we are living in now. The next chapter begins there. To understand why the modern economy feels so different today, we need to go back to one of the most dramatic financial moments in modern history. The year was 2008. Across the United States and much of the world, the financial system was collapsing. Banks that had existed for generations were suddenly on the edge of failure. Mortgage companies were going bankrupt. Housing prices were falling at speeds few people had ever seen before. Millions of families who believed they owned secure homes suddenly discovered they owed more on their mortgages than the houses were worth. The financial system had become dangerously unstable. For years leading up to the crisis, banks and investment firms had been creating increasingly complex financial products built on mortgage loans. These loans were packaged together and sold as investments. As long as housing prices continued rising, the system appeared to work. But when housing prices stopped rising, the entire structure began to unravel. Loans that were assumed to be safe turned out to be extremely risky. Financial institutions that held these investments suddenly faced massive losses. Confidence in the banking system began to disappear. And once confidence disappears in a financial system, things can deteriorate very quickly. Banks rely on trust. They borrow money from other banks. They lend money to businesses and households. If that chain breaks, the entire economy can grind to a halt. In the fall of 2008, that chain began breaking. Several major financial institutions failed within weeks of each other. Stock markets crashed around the world. Businesses stopped investing. Hiring slowed dramatically. Within months, the crisis spread far beyond banks and financial firms. It began affecting ordinary workers. Companies started laying off employees. Construction projects stopped. Stores closed. The unemployment rate rose rapidly as millions of people lost their jobs. The crisis became the worst economic downturn since the Great Depression. Governments around the world faced a terrifying possibility. If they did nothing, the entire financial system could collapse. Banks might stop lending completely. Businesses might not be able to pay employees. Consumers might stop spending altogether. This would trigger a downward spiral that could last for years. So policymakers made a decision. They would intervene in the financial system on a scale never seen before. The goal was simple: stabilize the system, restore confidence, restart economic growth. But the tools they used to achieve that goal would end up reshaping the economy for the next decade and beyond. The first major tool was interest rates. Normally, when central banks want to encourage economic activity, they lower interest rates slightly. Lower interest rates make borrowing cheaper. Businesses borrow to expand operations. Consumers borrow to buy homes and cars. Spending increases. Economic activity rises. During the financial crisis, interest rates were not lowered slightly. They were lowered dramatically. Rates fell to near zero. The cost of borrowing money became incredibly cheap. For banks and corporations, this was like opening a floodgate of financial opportunity. Companies could borrow money at extremely low rates. Investors could take loans and invest in assets that generated higher returns. But lowering interest rates was only part of the strategy. Central banks also introduced something new. They began purchasing enormous quantities of financial assets from banks and institutions. This process injected large amounts of money directly into the financial system. The goal was to ensure that banks had enough liquidity to keep lending. If banks could continue lending, businesses could continue operating. If businesses kept operating, workers would keep earning paychecks. At least that was the idea. In many ways, the strategy succeeded. Financial markets stabilized. Banks survived. The economy slowly began to recover. But something else happened at the same time. Because when money becomes extremely cheap to borrow, investors begin searching for places to put that money where it can grow. And during the years following the crisis, one destination became especially attractive: the stock market. Companies could borrow money at very low rates. Investors could borrow money at very low rates. And both groups began pouring that money into financial assets. Stock prices began rising. At first, the increases were modest. But as the recovery continued, those increases accelerated. Technology companies expanded rapidly. New industries formed. Corporate profits climbed. Investors became increasingly confident that markets would continue rising. And as confidence grew, more money flowed into the system. Over time, this process created one of the longest bull markets in modern history. From 2009 onward, stock markets climbed steadily upward. There were occasional downturns and corrections, but the overall trend remained strong. Corporate profits increased dramatically. Many investors saw their portfolios grow faster than they ever expected. Real estate also began recovering from the crash. Once the housing market stabilized, prices began climbing again. In many cities, they rose even faster than before the crisis. Homes became valuable financial assets once again. And because interest rates remained low for many years, borrowing to purchase property stayed relatively affordable for investors. This combination created powerful incentives. Borrow money cheaply. Invest that money into assets. Watch those assets rise in value. For people who already own stocks or property, the results were extraordinary. Their wealth increased year after year. Investment portfolios expanded. Home equity grew. Retirement accounts surged. For many households, the years following the financial crisis became a period of significant financial growth. But there was another side to this story. Because not everyone started that decade with the same financial position. Many younger people were entering adulthood right in the middle of the crisis. They graduated from college into one of the worst job markets in decades. Hiring was slow. Starting salaries were often lower than expected. Some graduates took jobs unrelated to their fields simply because opportunities were limited. At the same time, housing prices began rising again. For people who already owned homes, this created wealth. For people who did not yet own property, it created a barrier. The longer housing prices climbed, the harder it became for first-time buyers to enter the market. Down payments grew larger. Competition increased. Rent prices followed housing prices upward. Young workers trying to save money found it increasingly difficult to keep up. While investors watched their portfolios expand, many young adults were struggling just to build basic financial stability. And this gap between asset growth and wage growth quietly began shaping the economic experience of an entire generation. But the story does not end there. Because the recovery strategy that fueled rising asset prices also produced another powerful force. Corporate behavior began to change. Companies discovered that cheap borrowing created new opportunities not only for growth, but also for financial engineering. Instead of using borrowed money only to build new factories or hire more workers, many corporations used it in a different way. They used it to buy back their own stock. Stock buybacks became one of the defining features of the modern market. When a company buys its own shares, the number of shares available in the market decreases. When supply decreases while demand remains strong, the price often rises. This process can increase shareholder value and push stock prices higher. For investors, this was good news. But for workers, the benefits were less clear. Companies focused heavily on maximizing shareholder returns. Cost-cutting became a major strategy for maintaining high profits. Automation replaced certain jobs. Efficiency improvements reduced labor costs. The result was a corporate environment that rewarded investors while placing increasing pressure on the workforce. Over time, this dynamic strengthened the role of capital in the economy. Capital refers to assets that generate income. Stocks, real estate, investments. Labor refers to income earned from work. Wages, salaries, hourly pay. For much of modern history, both capital and labor benefited when the economy grew. But during the years following the financial crisis, capital began pulling further ahead. Asset owners experienced rapid wealth growth. Workers saw slower wage growth. This divergence became one of the defining economic trends of the 21st century, and it explains why financial markets can soar even while many households feel financially constrained. Because the modern economy increasingly rewards ownership rather than labor alone. But this transformation produced another unexpected consequence. As the gap between asset owners and wage earners grew, a new generation began questioning whether the system itself was becoming unbalanced. They looked at rising housing prices and wondered if homeownership would ever become realistic. They looked at growing student debt and wondered whether education was still the path to stability it once was. They looked at record corporate profits and wondered why their own paychecks had not increased at the same pace. These questions began shaping public conversation about the economy. And as those conversations grew louder, another issue started becoming impossible to ignore: the rising cost of everyday life. Housing, healthcare, education, food, transportation. Even though the economy was technically recovering, many essential expenses were rising faster than wages, which meant that for many people, the feeling of financial pressure never really disappeared after the crisis. Instead, it slowly evolved into something else: a long-term struggle to keep up with an increasingly expensive world. Understanding that struggle requires looking closely at one of the most powerful forces in the modern economy: the cost of living, and how it has changed faster than many people realize. Because the next chapter reveals why everyday expenses have become one of the most important pressures shaping the lives of younger generations today. In the years after the financial crisis, something unusual began happening in the economy. Financial markets were recovering. Corporate profits were rising, but the cost of everyday life was climbing faster than many people expected. For millions of households, it started with housing. Housing has always been one of the largest expenses in any budget. But in the past decade, it has become one of the most difficult financial barriers for younger generations. In many cities across the United States, home prices began rising rapidly during the recovery from the financial crisis. At first, the increase seemed like a healthy rebound after the housing crash. But as the years passed, the growth continued. Investors began buying properties in large numbers. Real estate became an attractive investment because interest rates were so low and housing demand remained strong. Large investment firms entered the housing market as well. Some companies began purchasing entire neighborhoods of homes and converting them into rental properties. As demand increased, prices continued climbing. For people who already owned homes, this trend created wealth. Their properties increased in value year after year. But for people who had not yet entered the housing market, the situation became increasingly difficult. Home prices were rising faster than wages. Down payments became harder to save. Mortgage approvals became more competitive. Many potential buyers remained renters longer than previous generations had. And rents began rising too. Landlords adjusted rental prices to match the increasing value of property. Cities with strong job markets experienced especially dramatic increases. Young workers who moved to these cities for career opportunities often found themselves spending a large portion of their income on rent alone. In some areas, it became common for rent to consume nearly half of a young worker's monthly income. When such a large percentage of income goes toward housing, saving money becomes extremely difficult. But housing was only the beginning. Education costs were rising at the same time. For decades, college had been presented as the most reliable path to financial stability. Students were encouraged to pursue higher education with the promise that a degree would lead to better job opportunities and higher lifetime earnings. But the price of that education increased dramatically over time. Tuition costs at many universities rose far faster than inflation. To cover these costs, students increasingly relied on loans. Student debt gradually became one of the defining financial burdens of modern adulthood. Millions of graduates began their careers carrying significant debt balances. These loans required monthly payments that could last for decades. For some graduates, the debt payments were manageable. For others, they became a constant financial pressure that delayed other life decisions. Buying a home became harder. Saving for retirement became harder. Even building a small emergency fund became challenging. And then there was healthcare. Medical costs in the United States have risen steadily for many years. Insurance premiums increased. Prescription drug costs increased. Hospital visits and medical procedures often carried high out-of-pocket expenses. Even individuals with insurance sometimes faced unexpected medical bills that strained their finances. Healthcare became another major cost that many households had to plan around carefully. And everyday living expenses followed the same pattern. Groceries slowly became more expensive. Transportation costs increased. Childcare costs rose dramatically in many areas. For families trying to balance all of these expenses, the pressure added up quickly. At the same time, wages were growing much more slowly. This created a financial squeeze that many younger workers felt every month. Income came in. Essential expenses consumed most of it, and very little remained for savings or long-term financial goals. This is one of the main reasons why many people say the economy feels harder today, even when economic statistics appear strong. The official numbers measure total economic output, but they do not measure how expensive daily life has become relative to wages. For younger generations, the difference is significant. Many millennials and members of Gen Z entered adulthood during a period when essential costs were rising faster than their incomes. And this created a feeling that something fundamental had shifted. Hard work alone no longer seemed to guarantee financial progress. People worked long hours. They earned degrees. They followed the traditional advice about building careers. Yet many still struggled to achieve the same milestones their parents had reached earlier in life. Buying a home, raising a family, building savings. These milestones became harder to reach not because younger generations were less motivated, but because the economic landscape had changed. The financial ladder had become steeper. At the same time, another powerful psychological force began shaping how younger people experienced the economy. Technology, specifically social media. In previous generations, people compared their lives mostly with neighbors, coworkers, and friends within their immediate communities. Today, comparison happens on a global scale. Social media platforms show constant streams of images and videos from people around the world. Luxury vacations, expensive homes, high-end lifestyles, successful careers, entrepreneurial achievements. Many of these images represent the highlights of people's lives rather than the full reality. But constant exposure to these images can create a powerful sense of comparison. Someone struggling to pay rent might scroll through a feed filled with images of financial success and feel like they are falling behind. This feeling can appear even when the comparison is unrealistic. The result is a psychological environment where financial pressure becomes both practical and emotional. People are not only dealing with rising costs, they are also navigating a world where success appears constantly visible and constantly measured. This combination of economic pressure and social comparison can amplify feelings of stress and insecurity. But financial pressure alone does not fully explain why younger generations often feel trapped in the modern economy. There is another powerful force that shapes their financial lives: debt. Debt plays a unique role in the modern financial system. For some people, it is a tool that helps them build wealth. For others, it becomes a long-term burden that limits opportunity. Understanding this difference reveals one of the most important hidden dynamics of the modern economy. Because not all debt works the same way. And the way debt functions for the wealthy is very different from the way it functions for the rest of the population. That difference may be one of the clearest reasons why the modern economy feels increasingly unequal. The next chapter explores that divide. The two completely different worlds of debt that exist inside the same financial system. Debt is one of the most powerful forces in the modern economy. It can build wealth, expand businesses, and create opportunity. But it can also trap people in cycles that are difficult to escape. The key difference lies in how debt is used and who has access to the best forms of it. In the modern financial system, there are essentially two completely different worlds of debt. One world is designed for people who already have wealth. The other world is experienced by people who rely primarily on wages. The difference between these two systems shapes the financial reality of millions of households. For wealthy individuals and large investors, debt is often used as a tool for expansion. Banks offer loans at relatively low interest rates to people who have strong financial histories and valuable assets. These borrowers can use that money to purchase assets that generate income or increase in value. Real estate is one of the most common examples. An investor might borrow money at a low interest rate to purchase a rental property. Tenants pay rent each month. The rent covers the mortgage payment and often produces additional income. At the same time, the property itself may rise in value over the years. The borrower benefits from both rental income and long-term appreciation. The borrowed money becomes a tool for building wealth. This process can repeat many times. An investor purchases one property, then another, then another. Each purchase is supported by loans that are relatively inexpensive because lenders view the borrower as low risk. Large corporations operate in a similar way. They borrow enormous sums of money at very low interest rates. They use that money to expand operations, acquire other companies, invest in technology, or repurchase their own stock. These activities can increase profits and raise share prices. When share prices rise, investors benefit. In this environment, debt becomes a powerful engine for wealth creation. But the experience of debt looks very different for most households. Instead of borrowing to purchase assets that generate income, many people borrow simply to cover essential expenses. Student loans are a clear example. Higher education is often necessary for entering certain professions, but the cost of that education has risen dramatically. Students borrow money in hopes that their future income will justify the investment. In some cases it does, but in many others the debt remains long after graduation. Monthly payments follow borrowers through their early careers. For some people, these payments delay major financial milestones. Buying a home becomes harder. Saving for retirement becomes harder. Starting a business becomes harder. Student debt does not usually generate additional income on its own. It represents a cost that must be repaid from wages. Credit cards create another form of financial pressure. When households face rising living costs and limited savings, credit cards can become a way to bridge the gap between income and expenses. Unexpected car repairs. medical bills, temporary job loss, emergency travel. Credit cards allow these expenses to be covered immediately, but the interest rates on these cards are often extremely high. If the balance is not paid quickly, interest charges begin to accumulate. Over time, the borrower may find themselves paying far more in interest than the original amount borrowed. This creates a cycle that can be difficult to break. Income goes toward paying interest rather than building savings or purchasing assets. While wealthy investors use low-interest loans to acquire appreciating assets, many households are using high-interest credit to manage everyday expenses. Both groups are using debt, but the outcomes are completely different. One group sees wealth expand. The other struggles to stay financially stable. This difference is not always obvious when people first enter the financial system. Young adults often assume that borrowing money for education or basic needs is a normal part of modern life. But over time, the long-term effects become clear. Debt payments reduce the amount of money available for saving and investing. Without savings, households remain vulnerable to unexpected expenses. Without investments, they miss out on the asset growth that has driven much of the economy in recent decades. This gap between asset owners and debt-burdened households can widen year after year. And as it widens, the economy begins to feel increasingly divided. Some people experience rising wealth through asset ownership. Others experience financial pressure through rising debt obligations. This dynamic is one of the reasons many critics argue that the modern financial system is structured in a way that favors capital over labor. Capital refers to assets that produce income. Labor refers to income earned through work. In a balanced system, both forms of income can support long-term financial stability. But when asset growth significantly outpaces wage growth, the balance begins to shift. The people who own capital accumulate wealth faster. The people who rely primarily on wages must work harder to achieve the same level of financial progress. And this shift has been happening for several decades. The years following the financial crisis accelerated the process. Low interest rates made borrowing cheap for investors. Asset prices rose quickly. At the same time, the cost of living increased faster than wages in many areas. Households borrowed more to cover everyday expenses. This created a system where debt played two very different roles at the same time. A ladder for some, a weight for others. And the consequences of that divide extend far beyond personal finance. They influence social mobility, economic opportunity, and even mental health. When people feel that financial progress is becoming harder despite working hard, frustration begins to grow. Questions emerge about fairness and opportunity. Younger generations begin asking whether the economic system still offers the same pathways to stability that previous generations experienced. Some argue that the system simply reflects market forces and global economic change. Others argue that policy decisions and financial structures have unintentionally favored asset owners over workers. The truth likely lies somewhere between these perspectives. But what is clear is that the experience of the economy has become very different depending on where someone stands within it. For people benefiting from rising asset prices, the past decade has been remarkably prosperous. For many younger households navigating rising costs and heavy debt, the same decade has felt uncertain and financially stressful. And this stress does not remain confined to bank accounts. It often appears in emotional and psychological ways. Financial pressure can shape how people think about the future. It can influence their relationships. It can affect their sense of stability and hope. Which brings us to another major question surrounding the modern economy. Why are younger generations reporting higher levels of anxiety, loneliness, and depression than previous generations did at similar ages? Economic pressure is not the only explanation, but it may be one of the most important pieces of the puzzle. The next chapter explores the growing connection between financial uncertainty and the mental health struggles experienced by millions of younger adults today. Money is often discussed as a practical issue. Budgets, savings, investments, debt. But money is also deeply emotional. It shapes how people think about the future. It influences relationships, personal decisions, and a sense of stability in everyday life. When financial systems change, the emotional effects often follow quietly behind. Over the past decade, researchers and public health experts have noticed a pattern that has become difficult to ignore. Younger generations report higher levels of anxiety, loneliness, depression, and long-term stress than earlier generations did at similar stages of life. There are many reasons for this trend. Technology has changed how people interact with one another. Social media has transformed communication and comparison. Global news travels instantly and exposes people to constant information about crises and uncertainty. But one factor consistently appears in discussions about these trends: financial insecurity. For many young adults, the economic path that earlier generations followed feels less predictable today. The traditional sequence once seemed relatively clear: graduate from school, start a career, save money, buy a home, build a family, slowly accumulate financial security over time. For millions of younger people, that path now feels far more uncertain. Many graduate from school already carrying large student loan balances. They enter housing markets where prices are historically high relative to income. They see healthcare costs rising. They experience job markets that change rapidly due to automation, outsourcing, and technological shifts. The result is not always immediate financial crisis, but it often produces something more subtle: persistent uncertainty, a feeling that the future is harder to predict. When people cannot clearly imagine their financial future, stress becomes a constant background presence in daily life. Small financial setbacks feel larger. Unexpected expenses feel more threatening. Long-term planning becomes difficult. This kind of pressure does not always appear dramatic in a single moment. Instead, it builds slowly over time, month after month, year after year. At the same time, modern technology has introduced another powerful influence on emotional well-being: comparison. In earlier generations, people compared their lives primarily with neighbors, coworkers, or friends within their communities. Today, comparison happens on a global scale. Social media platforms present endless streams of images, videos, and stories from people around the world. Luxury lifestyles, successful careers, expensive travel, beautiful homes, perfect-looking lives. These images represent curated moments rather than complete realities. But the human brain still processes them as social comparison. Someone struggling financially may scroll through hundreds of examples of apparent success in a single evening. Even if those images represent only a small fraction of real-life experiences, the psychological effect can be powerful. It creates a feeling that others are moving ahead while you remain stuck. Over time, this feeling can influence self-perception. People begin questioning whether they are making the right decisions, whether they are falling behind, whether success is becoming harder to achieve. This dynamic becomes even stronger when financial stress is already present. Economic pressure and constant comparison reinforce each other. One creates worry about the future. The other magnifies the perception that everyone else is succeeding. And then there is another factor that shapes the emotional outlook of younger generations: the experience of growing up during multiple major crises. Millennials entered adulthood during the financial crash of 2008. Many watched their parents lose jobs, homes, or retirement savings. That experience left a deep impression about how fragile economic systems can be. Just as that generation began rebuilding stability, another global crisis arrived. The pandemic disrupted economies across the world. Businesses closed. Entire industries paused. Millions of people lost jobs again. For younger workers who had already experienced one major economic shock early in life, this second disruption reinforced a sense that stability could disappear at any moment. These experiences shape long-term attitudes toward money and security. People who live through repeated economic shocks often become more cautious. They may delay major life decisions. They may save aggressively if possible, or they may feel discouraged about long-term planning altogether. In some cases, this uncertainty contributes to feelings of isolation. Financial stress can limit social activities. It can delay moving out of family homes. It can affect relationships and family planning. When economic pressure intersects with social comparison and uncertainty about the future, emotional strain becomes difficult to avoid. This does not mean financial factors alone explain the rise in mental health struggles among younger generations. Human psychology is complex. Technology, culture, and social change all play important roles. But economic stress often acts as a background condition that amplifies other pressures. It makes everyday challenges feel heavier. It makes long-term planning feel uncertain. And it can create the sense that the path toward stability has become harder to find. As these feelings spread, public conversation about the economy has begun to change. More people are asking deeper questions about how the financial system operates. Why has wealth grown so dramatically in financial markets while many workers feel squeezed? Why have housing and education become so expensive relative to wages? Why do younger generations carry so much debt compared with earlier generations? These questions lead to a larger debate about the structure of the modern economic system. Some critics argue that the system increasingly rewards capital and asset ownership, while placing greater pressure on wage earners. Others argue that technological change and globalization have naturally reshaped economic opportunities. But regardless of where someone stands in that debate, one fact is clear. The gap between financial markets and everyday experience has become impossible to ignore. The stock market may be booming. Corporate profits may be rising. But the emotional experience of the economy tells a more complicated story. A story of uncertainty. A story of rising costs, and a story of younger generations trying to build stable lives within a system that feels very different from the one their parents experienced. This tension has led to a growing belief among some observers that the system itself may be tilted in ways that favor certain groups over others. Whether that belief is entirely accurate or partly misunderstood is still debated. But the perception alone has become powerful. It has sparked discussions about fairness, opportunity, and the long-term direction of the economy. And it leads to one of the most controversial questions surrounding modern finance. Is the system simply evolving with global markets? Or has it gradually become structured in ways that benefit the wealthy and powerful more than the average worker? The next chapter explores that question. It examines the policies, financial incentives, and economic structures that critics say may be shaping the modern economy in ways most people never see. As the years passed after the financial crisis, a new kind of conversation began spreading across the country. It did not start in government offices or economic conferences. It started in living rooms, workplaces, and online communities. People began asking a simple but uncomfortable question. If the economy is doing so well, why does it feel like so many people are struggling? For decades, the idea of economic growth carried a clear promise. When the economy grows, opportunity expands. Businesses hire more workers. Wages increase. Families build wealth. Each generation gradually experiences a better standard of living than the one before it. For much of the 20th century, that promise often held true. But in the 21st century, many younger adults began noticing something different. The economy was growing. Yet their personal experience did not always reflect that growth. This led some critics to argue that the structure of the modern financial system may have quietly shifted, not through one dramatic decision, but through a long series of policies and incentives that gradually changed how wealth is created and distributed. To understand this argument, it helps to look at how financial markets interact with government policy. In times of crisis, governments often intervene to stabilize the economy. This happened during the financial crisis of 2008. Large financial institutions received emergency support to prevent the collapse of the banking system. Central banks injected massive liquidity into financial markets. These actions were designed to protect the broader economy. If banks collapsed completely, millions more people could have lost jobs, savings, and access to credit. But the rescue also created a lasting perception. Many people felt that the financial system had been protected more aggressively than ordinary households. Banks recovered quickly. Financial markets rebounded. Meanwhile, many families spent years rebuilding their finances after job losses, foreclosures, and reduced income. For critics, this moment became symbolic of a larger issue. The idea that financial institutions may receive stronger protection during crises than individual workers. Another major area of debate involves tax policy. In many countries, income earned from investments is taxed differently from income earned through wages. Capital gains taxes on long-term investments are often lower than the taxes applied to regular income. Supporters of this policy argue that lower capital taxes encourage investment and economic growth. Critics argue that it favors people who already possess significant wealth. If most wealth growth comes from investments rather than wages, lower taxes on investment income can amplify the advantages held by asset owners. Then there is the issue of corporate influence. Large corporations play a major role in the modern economy. They create jobs, develop technology, and produce goods used by millions of people. But they also possess enormous financial resources. These resources allow corporations to shape policy discussions through lobbying, campaign support, and political influence. Critics argue that this influence sometimes leads to policies that prioritize corporate profitability over worker welfare. Supporters counter that strong corporations are necessary for economic growth and innovation. The debate continues. Housing policy is another area where critics see structural problems. In many cities, the supply of new housing has not kept pace with population growth. Zoning regulations, construction costs, and local opposition to development have limited the creation of new homes. When housing supply grows slowly while demand rises, prices increase. Homeowners benefit from rising property values, but renters and first-time buyers face increasingly difficult entry into the market. Over time, this dynamic can create large wealth gaps between those who already own property and those who do not. Student debt also plays a role in the discussion. Education has long been considered a pathway to upward mobility. But as tuition costs increased, students relied more heavily on loans. For many graduates, the debt payments last for years or decades. Critics argue that this system shifts the cost of education heavily onto young individuals rather than society as a whole. Supporters argue that higher education still provides long-term financial benefits, and that borrowing for education remains a worthwhile investment for many careers. The truth likely varies depending on the field of study, the cost of the institution, and the job market. But the financial burden is undeniable for millions of borrowers. All of these factors together create a complicated picture. Rising asset prices benefit investors and property owners. Low interest rates support corporate borrowing and financial markets. Tax structures sometimes favor investment income. Housing shortages increase property values while limiting access for new buyers. Education costs create debt for young workers. None of these policies alone necessarily define the entire system, but together they shape how wealth moves through the economy, and they influence who benefits most from economic growth. For some observers, the conclusion is clear. The system increasingly rewards people who already possess capital. For others, the explanation is more complex. They argue that technological change, global competition, and demographic shifts are the primary forces reshaping economic opportunity. Automation reduces demand for certain jobs. Global supply chains increase competition for labor. Aging populations concentrate wealth among older generations who have had more time to accumulate assets. From this perspective, the economy is not intentionally rigged. It is simply evolving faster than social systems can adapt. But regardless of which explanation someone believes, one reality remains clear. The economic experience of different generations has diverged significantly. Older generations who purchased homes decades ago often benefited from long periods of asset appreciation. Younger generations entering adulthood today face higher entry costs for many of those same assets. And as long as asset prices continue rising faster than wages, that gap may continue growing. This brings us to the final and most important question. What happens next? Will the economic system gradually rebalance as new policies emerge and markets adjust? Will younger generations eventually accumulate wealth as they age and enter asset markets? Or will the structural forces shaping the modern economy continue widening the gap between asset owners and wage earners? History shows that economic systems are not static. They evolve, sometimes slowly, sometimes suddenly. Major changes often occur during periods of political pressure, technological transformation, or social demand for reform. The future of the modern economy may depend on how societies respond to the challenges now becoming visible. Housing affordability, student debt, wage growth, access to asset ownership, financial security for future generations. Each of these issues is part of a larger conversation about opportunity and fairness in the economic system. But before we reach any conclusions, there is one final perspective worth exploring. Because despite the challenges younger generations face today, the story of the modern economy is not only about struggle. It is also about adaptation, new technologies, new forms of work, new economic possibilities that did not exist for earlier generations. The final chapter looks forward at the potential paths the economy might take in the decades ahead. For most of modern history, each generation believed that the future would look better than the past. Parents expected their children to have more opportunity, more financial stability, and a higher standard of living than they did. That belief became deeply woven into the identity of the American economy. Work hard, build a career, save money, buy a home, raise a family, gradually build wealth over time. For decades, this path felt achievable for millions of people. But today, many younger adults look at the future with a different kind of uncertainty. Not because opportunity has disappeared entirely, but because the path toward stability feels far less predictable than it once did. Housing costs are high. Education is expensive. Debt follows many people for years. The job market evolves quickly as technology transforms industries. And while financial markets continue to reach new highs, the benefits of that growth do not always reach everyone equally. This leaves younger generations standing at a crossroads. They are entering adulthood during a time of enormous economic change. Some of those changes create new challenges, but others may create opportunities that previous generations never had. Because the same forces reshaping the economy are also opening doors that did not exist before. Technology is one of the most powerful examples. Digital tools have transformed how people work, communicate, and build businesses. Just a few decades ago, starting a company often required significant capital, physical infrastructure, and access to large networks. Today, someone with a computer and an internet connection can reach a global audience. Entrepreneurs can launch online businesses, develop software, build digital platforms, and create entirely new forms of work. The rise of remote work has also begun reshaping the geography of opportunity. For many workers, the traditional requirement to live near a specific office is beginning to fade. People can work for companies located thousands of miles away while living in entirely different regions. This shift may gradually reduce the pressure created by expensive housing markets in major cities. It may allow more people to pursue careers without relocating to the most expensive urban areas. At the same time, technological innovation continues to create entirely new industries. Artificial intelligence, biotechnology, renewable energy, and advanced manufacturing are rapidly expanding fields. These industries may produce new forms of employment and economic growth that reshape the job market in ways that are difficult to predict today. History shows that technological revolutions often create temporary disruptions followed by long periods of innovation and opportunity. The challenge is navigating the transition. But technology is only one piece of the future economic puzzle. Another powerful force is generational change itself. As older generations retire, enormous amounts of wealth will gradually transfer to younger generations. Economists sometimes refer to this as one of the largest wealth transfers in modern history. Homes, retirement accounts, investments, and family businesses will eventually pass to heirs. This transfer will not solve every economic challenge, but it will reshape the distribution of assets over time. At the same time, younger generations are beginning to influence the direction of economic policy. Every generation eventually becomes the primary workforce, the primary group of voters, and the primary drivers of consumer demand. As millennials and members of Gen Z grow older, their priorities will increasingly shape political and economic decisions. Issues such as housing affordability, student debt, healthcare costs, and wage growth may become central topics in future policy debates. Societies often respond to economic pressure through gradual reforms. Housing regulations can change. Education financing systems can evolve. Labor markets can adapt to new forms of work. These changes rarely happen overnight, but history shows that economic systems are constantly adjusting. The economy that exists today is very different from the one that existed 50 years ago, and 50 years from now it will likely look different again. This perspective does not eliminate the challenges younger generations face today. The pressures of rising costs, debt, and financial uncertainty are very real. But it also reminds us that economies are living systems. They respond to innovation, social change, political decisions, and generational influence. The future is not predetermined. It is shaped by the choices societies make over time. Younger generations may demand different priorities. They may push for policies that address housing supply, education costs, and financial inequality. They may develop new forms of work and entrepreneurship that challenge traditional economic models. They may build technologies that create entirely new industries. At the same time, The financial system itself may continue evolving. New forms of investment are emerging. Digital finance is changing how money moves around the world. Global markets are becoming increasingly interconnected. These developments carry both opportunity and risk, but they also suggest that the economy of the future may not operate exactly like the economy of today. And this brings us back to the central question that started this entire discussion. Why does the economy feel so different for younger generations? Part of the answer lies in the timing of their entry into the workforce. They came of age during financial crises, rising costs, and rapid technological change. They entered asset markets later, when prices were already high. They navigated education systems that required greater borrowing. They experienced a world where economic growth and personal financial security often seemed disconnected. But the story is still unfolding. The generations that feel the pressure of economic change today may also be the ones who reshape the system tomorrow. Every generation inherits an economy built by the decisions of the past, but every generation also contributes to building the economy of the future. The policies they support, the businesses they create, the technologies they invent, the cultural values they promote. All of these choices gradually shape how wealth, opportunity, and stability are distributed. So the real question is not simply whether the system feels difficult today. The real question is what the next generation will do with the power to change it. Will the gap between asset owners and wage earners continue widening? Will housing and education remain increasingly expensive? Or will new ideas, new policies, and new innovations create a system that feels more balanced for future generations? History offers one consistent lesson. Economic systems are never permanent. They evolve as societies evolve. And the future of this economy will not be determined only by markets or institutions. It will also be determined by the choices millions of people make in the years ahead. The decisions about how to work, how to invest, how to vote, how to build communities and opportunities for the next generation. Which leaves us with one final question. If the economy of today feels uncertain and unequal to so many people, what kind of economy will the next generation decide to build tomorrow? Don't forget to subscribe on your way out. See you next video.